Would you like to be able to predict how much a stock price could move to the upside or the downside over a given period of time? Well, you can, and it's quite easy, and you don't have to use complex mathematical formulas to do so. All you need to know is a bit about options, and don't panic, you don't need to know much there, you just need to know the process, and in this video I'm going to show you how to do it. So with that, let's get on and take a look. So this is quite a neat trick. You want to calculate the potential for, say, a stock price to move as it approaches an event that you've highlighted. Then you can quite simply do this by following the rules laid out here. It's the back of a cigarette packet type way. There are some mathematical ways of doing it, but this is really straightforward and simple. All you need to do is find the at the money straddle for the stock you're looking at, and the important bit here is to put the expiry of that as close to the event date, whether it's earnings or product release, whatever, or as close as you can to that date, and then find out what the cost of that at the money straddle is. And then all you have to do is divide that cost by the current stock price to get the plus minus percentage move that the market thinks is going to happen up to that date. So it's really easy to get the implied move based on the options. So we'll take a look at a hypothetical example and it'll make it all make total sense. So we're looking at stock ABC Inc. Current stock price is $100. Now the $100 at the money call for the scenario we're looking at, it's about a week away, is the call is worth $6 and the put is worth $5.50. Now together the straddle will cost us $11.50. So that means the implied move up to our expiry event date can mean that the price can move in a range to the upside of $111.50 and the downside of $89.50. Now if you want to work out what that is in percentage terms, you just take that price of $11.50 and divide it by the current stock price there, $100, and you get that plus minus 12% move. So a really nice straightforward way to calculate implied move of the underlying stock. So why bother at all with this simple calculation? Well, the real important reason is if you're going to invest in a stock, there's no point investing or trading it if the price isn't going to move. So this calculation gives you a great insight into the potential of the stock price movement over a given period of time. So if you're a short-term trader for a few days or even a longer one of many months, this will give you an idea, the implied price move of the stock that you're looking at, and you can calculate, like I say, in a really quick and easy fashion. So let's now take a look at a real world example. So I have a couple of examples for you for how to find the data, and I'm going to use Tesla as my example, and my hypothesis is by the 14th of April I want to be wanting to know where the price of Tesla to the up or downside is going to be. Is it going to move? Is it worth getting into the stock? So I went into barchart.com, free website, typed in Tesla. It's got loads of detail down the side, found options prices. You can see the current price $9.64, so we're looking for the at the money price around there. Now we wanted the expiration date, and fortunately it's smack bang on that date, which is 20 odd days away from now. So we've selected that, brings up the prices. As you can see, the at the money is highlighted in these light sort of green areas. We can see 963.5, 964, so we're somewhere around about here, so you can pick either or. 47.75 for the calls. Remember, we're buying them, and we're buying the puts, so that's 58.70, in that sort of range. Add them together, and then, like I say, divide that number into the strike price to get our percentage moves, and then, as most brokers should, you should be able to use their platforms to pull off this data as well. So I'm just going to have a look at one of those now. So my second example, using my brokerage account called First Trade, went through the same process, typed in Tesla, pulled up the options chain, found the closest expiry date, April the 14th. Then we can see the price around about 960. Go down to the calls, 54.45, over to the puts, same sort of money, 54.55. Add the two together, divide it by the price, go through the same process and work out that percentage move. So now let's just go through that, on paper to see what that percentage price move. It's roughly about 22 days, I think, to that expiry from me producing this video. Here's that example taking the First Trade data for Tesla. Remember, the expiry about 22 days out, so we picked the 14th April 22 expiry date. Stop price 960, call and the puts together $109. Result of all that lot means the price can move by $109 in either direction, which gives us a range between $851 and $1,069. And in terms of actual percentage move, that is plus minus 11.35% over the next 22 days. So a reasonable move there, and that would indicate to me that, definitely worth playing Tesla as a stock. So here you're asking me, why should this work? Well, it's all about option pricing and those traders putting in parts of the price in terms of implied volatility to come up with a price for the calls and the puts. That's all you really need to know for now. If you'd like to get more into the options side of trading, then I've got loads of content on the YouTube channel and on my website, so don't forget to subscribe, hit that bell notification button to receive further content of this sort of stuff that I will be producing.